the workshop on finance and bookkeeping. Jumpstart is the signature professional development project of the Rotaract Club of Achievers Lanka Business School. Of the Rotaract Club of Achievers Lanka Business School, which was conducted for the 4th consecutive year. And Jumpstart is a platform for budding entrepreneurs to pitch their creative business ideas to a panel of judges in order to win prizes worth 100,000 rupees, along with knowledge and mentorship from the best in the industry. Also, we connect growth stage startups with investors and give them an opportunity to receive investments for their businesses. So today's workshop will give you an understanding on how to manage finances and how to tackle the challenges encountered with them. Before moving on to the workshop, here's a small shout out to our bronze partner Seema, gift partner Shirtworks, and the co-working space partner Hub9.
Our story is one of reimagining. Reimagining who you can be, what you can achieve, and how Seema can support you. By reimagining and delivering the skills that create value for businesses, we are building an ecosystem of progress and placing you right at its center. Reimagine your career. Contact Seema Sri Lanka.
Hi guys, my name is Pula. I'm an entrepreneur. I work as a student coach and my business is based around YouTube. Hub9 has played a major role in my work life. Since Hub9 offers 24/7 access, it has been very convenient for me. Between shooting, editing my videos and doing coaching sessions, I work on a very flexible schedule. There's air conditioning, you can just come in and plug your laptop and start work. There's no hassle at all. The staff and the people you find here are really friendly. You get tea as well, so overall you can just focus on your work and get a lot of it done within a day. The internet speed here is super fast and that has helped me a lot with my upload. There's a chill out area downstairs. I go there when I need to take a break or just a change in my environment. It helps to keep my balance while I'm working here. This meeting room is really nice. I have used it for some of my interviews and I also use it for my coaching sessions and meetings with clients. If you are working here, you can easily book it for your meetings as well. During the pandemic, Hub9 has taken all the necessary precautions to keep all of us safe, so that's all good. The value I get for the 15,000 rupees I invest at Hub9 is just amazing. If you're just starting off your business, this is a good place to start.
By Mr. Kavinda Dasanayake, the Director of Extroasia Private Limited. Mr. Kavinda Dasanayake, over to you.
Thank you, Vinori, for that introduction. Now, first, I would like to get to know where the audience is at. In other words, what is a rough idea of what your background is. Let me ask you some questions, and when I do, the people who fall into that category, you have your reaction button down, where that is, right? From that, just put a thumbs up so I can see and get a rough idea how many of you fall into this category, because that will help me to deliver, conduct these sessions when I have an idea, basically what is your background in terms of finance, right? And also I like to keep this session very informal and interactive. So keep your mics muted, but at any time, please feel free to unmute your mic and ask any question during the session. No problem. You don't have to wait till the end. You can, if there's something that's not clear at a particular point, please ask any questions, right? Now, let me first ask, raise your, give a thumbs up if you have studied any accounting, in the sense you're following either accountancy course or for your A levels you have done commerce accounting, like that. If you have had any exposure to accounting or any kind of understanding, please put your thumbs up. Okay. I think from that reaction, more than half of you have not had any exposure. So that is okay, because today I have structured this session also with the view that for an audience who has had no exposure for accounting or financing, to make things very simple and very basic. Let me ask you another question. Out of you, how many have already started the startup? Who's having a running like a startup business already? Can you put your thumbs up? Okay. Then my next question, how many of you have sort of created a business plan and now in the stage of maybe presenting that business plan to maybe a business plan competition, or you have not started your startup yet, but at least you have a business plan and you're in the stage of pitching it maybe to investors or business plan competitions. How many of you are in that stage? Okay, not many. Then let me ask you the final question probably. How many of you foresee starting a startup in the near future? I mean, let's say within the next 1 year or so, how many of you seriously are considering starting a startup? Thumbs up. Okay, good. So now let me share the screen and go into the session. Okay, you all of you can see the screen, right? Thumbs up if you can. I didn't get a response. Can you see the screen? Okay, right. Then let's. Okay, right. Thank you, Inuri. Right. So yeah, I'm Kavinda Dasanayake, and I have two colleagues with me also with us. They also can help you with your questions. They also have a lot of experience in finance and bookkeeping. One is Prashana Samaravira, who's the CEO of Extroasia. She was a former CFO of one of the leading software companies in Sri Lanka. And we also have Mr. Saman Veerasinghe, who is currently the CFO of PG Martin Group of Companies with us. Now, let me first give you like a very broad outline about today's session and what we are going to do and what we are going to achieve. Approach will be something like this. Now, in a session of 1.5 hours, or let's say now little bit less than that, it will not be possible to teach you accounting, right, or bookkeeping to the extent or to the level that you require in order to do your own accounting or bookkeeping, provided you have not had any background in bookkeeping and accounting, right? But don't worry. I will tell you how to get around that and what you can do about it, right? But more importantly than the skill of bookkeeping or accounting, I'm going to leave you today with some takeaways. These are actually things to think about and sort of have a broader view and understanding, which will be very valuable and essential for you from the finance side to understand before you start a business. It is basically the underlying philosophy. This will be the key takeaway that I plan to share with you. And some of these things will be points that you had to take home, or maybe already home, but think about on your own and reflect on, because they will have a kind of a big impact on your startup project. So let me first ask a question. Why do you need to do accounting or bookkeeping in a startup? You can please, one by one, you can unmute yourself. Anybody who wants to sort of give an answer. I would like to keep this like a discussion and very informal. So I'm not looking for a right answer or a wrong answer. Just any idea that you have. Why do you need to do accounting and bookkeeping in a startup?
To have an idea about that our startup is profitable or not.
Yes, very good. What else?
To keep a track on what we are doing day to day, what are the expenses, so we can minimize it and go efficiently.
Yes, very good. What else? Any other reasons why we should be doing this? Okay, let me give you some of the reasons why we need to do accounting and bookkeeping. First one is for your business, as one of you correctly pointed out, for your business decisions and planning. This is for your budgeting purposes, for decision making, for your pricing, for all of these things. You need to have an idea about your finances. Another thing is a health check to make sure that the company is running like it's supposed to. Like when you do finances, from that you can track certain things where there are inefficiencies, you can track where there are problems, you can track. If there's theft and pilferage, you can track. Some problems may not be even very visible from the outside, but when you check your numbers, you will realize there are problems. So that is another aspect. Then for preparing annual accounts. Now, if you have investors, they will require you to provide them with annual accounts, sometimes not annual, even monthly accounts. Then for your tax purposes, it's a must that you have to file your taxes, and for that you have to have a set of audited accounts. Likewise, you are required to prepare accounts for these various requirements. Then another one is tax. If you have a company, then you have to file your taxes, and for that you need to have a set of accounts. So these are some of the reasons why you need to have accounts and bookkeeping in a startup. Now, just like anything, putting the right foundation is very important, even for a startup. When you have a strong foundation, like you can build a big structure on top of it, like a house or building. So likewise, when you have the right foundation, you can build the company and other things based on that. But if you don't have the right foundation, there can be a lot of problems later on. So some of the basic things. One thing is to register a company. Now, why do you need to register a company? Why can't you just do it on your own, or just as a partnership? Why do you need to register a company? There are several reasons for this. One of the main reason is, as a company, you limit your liability. What do I mean by that? When you register a company, in the eyes of the law, that is seen as an entity or a person. So therefore, if in case there is a court case or there are some damages, that there's a court case to sue the company, it's only limited to the company. The owners and the directors are not directly responsible. So this is important. Now say you're doing business as an individual, like a sole proprietorship, or as a partnership. You manufacture some kind of a product. A customer takes that product, and as a result, there can be some fault in that product, and as a result, there's injury or death or some other big loss to their business or to individual self. Then they can go to courts and sue you for a faulty product. Now, if you're doing it as a proprietorship or a partnership, then you're personally liable, which means if the court says damages are 100 million or something like that, they can come and take hold of your property, your house, your car to settle that. Whereas if you are a company and registered as a company, the liability is limited to the assets of that company. Let's say the company, all the assets is just only 1 million, or you have some money in the bank, some other assets, the worth value of that is only 1 million. Courts can only go up to what the company owns. In other words, it can't come after you as a person. It can't come and take away your car or your house like that. So this is one of the main reasons. However, there is one caveat in this. That is, if you have done some illegal thing in the company as a director, then the law can come after you personally. For example, companies that that has employees have to pay EPF and ETF. Now, if you don't pay your EPF and ETF and default on that, if there is a court case, they go to a labor tribunal or court case, and if the company does not have money to make that settlement, they can come after the personal assets of the director. So they can come and seize your car or seize your house or your property. So basically, as long as you stick within the law without doing anything illegal, you're safe. If the company goes bankrupt naturally, or the business is low, let's say during COVID time, that's not a problem. If the company does not have assets to pay those liabilities, that is not a problem. To the extent the company has the assets, they can pay the liabilities and it stops there. Long as I said, you have not done something against the law or illegal, right? Now, apart from that, registering a company is also important because to monitor the progress of your business, it's difficult when you do it in a personal capacity. When the company is an entity of its own, because it's in isolation, it's very easy to see where the money is coming, where the money is going. If you're mixing it up with your personal money, it's difficult to track the health of the company on its own. Later on, you will need to get investors to invest in your company at some point. At that point also, when it's a separate entity and all the accounts and records are very clean and separate, it's not mixed with your personal business or personal other activities, it's that much easier to for the investors also to look at the company as a separate entity. later on, much later, when you go for a bank loan also, you can show that this company has been operating for so many years and you have a record of the finances, the cash flows. So even to secure a bank loan, it helps to have a registered company. However, nowadays, registering a company is an easy thing. It will cost you around maybe 50,000 to 60,000 rupees, right? And it will take about 14 days roughly to register a private limited liability company. However, sometimes I understand you may not be in a situation, or at least at the very beginning, to do this either because of financial constraints or for various other reasons. But my recommendation is, as soon as it's possible, make it a priority to register a company. As soon as it's practically possible. It's quite common for companies to, initially for startups. Can you please switch it off? Mute it, please. Okay. However, I should also give you another small warning. When you do register a company, then you have to, there are other things also that come with it. Basically, you have to file your taxes. You have to do your accounts annually, get those accounts audited. And you have to file with the registrar of companies. You have to file annual reports. It sounds big, but it's actually a very simple thing. Annual returns with registrar of company means it's like an update of, because when you register the company initially, they take some information or basic information about you. Annual returns is basically like a reaffirmation of that information. It will ask for who are the directors, information like that. So it's like a reaffirmation of that, but you have to do it. It's a simple thing, not a complicated thing, but you have to do it. You can't miss it. Otherwise, there'll be penalties. Same thing with taxes. Even if you don't have profits, you still have to file a nil report saying that you don't have any tax liabilities. So having no profits or not having any taxes due is fine, but annually you do have to file that report. So those are some of the things that come when you register a company, but it is good to get into that discipline early on, earlier the better. Another thing that you have to do is to open a bank account. This is to separate the third point was separate personal business from company's business. So in the name of the company, open a bank account. And most probably you will have to open a current account, because only in a current account you can get a checkbook. Checkbook is very useful and essential when you're running a company, because you can't settle everything with cash. Certain payments, statutory payments, certain things have to be done with checks. Now we are moving, especially after the COVID, we are moving more and more towards a digital era. So a lot of the payments now can be done via wire transfer and digitally also, but we are still not 100% there. So as of, if you start a company right now, I would still say having a checkbook is mandatory. Mandatory in the sense you will need it for your business. And to do that, you will have to open a current account, because having a savings account, you will not get a checkbook. And to open a current account, depending on the bank, they might ask for a deposit of like a running balance of maybe about 50,000 rupees in that account. And also, a current account does not give you interest. So this is also something that you have to bear in mind. Unlike a savings account, a current account will not give you interest. But slowly we are moving towards the digital era, and one day checkbooks might be the thing of the past, but we are not there yet. So the third point I touched on earlier also. So you have to separate your personal finances from the business finances. Now this also, it's quite common when you first start. A lot of the startups, the person, the founder or the co-founders, they just put money out of their pockets and manage the expenses. But if the way to go about it is, at the very beginning, you should do a calculation, let's say for the first 6 months or 1 year, how much money this company will consume, right? and then set that money aside and put it in put it into the company and record it as such. So the founders have invested in the company initially, let's say 100,000 rupees or 200,000 rupees, and from that amount you can pay your expenses and record it like that. So later on, even when an investor comes and looks at it, there is a paid in capital, there is a paid up capital or a invested capital in the company. And it will be also very clear even to show what were the expenses of this company very clearly, because you're taking that money out of that amount you have invested in the company. I hope that is clear. Okay. Now what I will do, as I mentioned to you earlier, it is from a session like this, it is not possible for me to teach you accounting or bookkeeping to a level that you will be able to go back from this session and do your own accounting and bookkeeping. This is for the vast majority of you who have not had any exposure to accounting, right, or bookkeeping. So therefore, I will give you a basic tool, or I'll tell you a method, very easy method, how to get about getting your accounting and bookkeeping done. A very simple method. Now, those of you who have had some accounting experience or who are studying accounts, of course, you don't have to follow this method. You can go ahead and according to your knowledge, you can do your accounts, right? There are three basic tools with which you can for the first couple of years, you can manage your accounts in a startup. First thing is a receipt book. Number two, the payment voucher. And number three is a record book. Now I'll go one by one and explain to you what each of these are. Now, for the purpose of illustration here, I'm going to show this, how this was done back in the day with paper, with paper receipts, paper vouchers like that. But in this day and age today, you can easily use Excel, and there are other accounting software also that you can use. But just for the purpose of illustration, I will show you the old-fashioned way how a paper receipt will look like. Even to this day, some basic organizations still use that. Now, for example, last year I was the treasurer of our Toastmasters club, and now in that club there are very few transactions for a given year. So it's possible to do it like this on paper, and all the previous treasurers have done it like that on paper also. So I just, without changing anything, continued the same process. As a startup, you will also have very limited number of transactions. It won't be like a big company where there's for any given day hundreds and thousands of transactions happening. It will be just very few. Maybe you might have a couple of transactions for the whole week. Sometimes may not be even that, depending on the particular business that you have started. Therefore, okay, receipt is like this. Now, this is like a format for a paper hard copy receipt. There are also Excel versions of formats of this that you can download from Google. You can Google it and there'll be so many sites from which you can download. You can even go and buy a receipt book from a bookshop. They have generic receipt books. And on that, you can just put your company seal and use it. The receipt book will have one side receipt that you issue to your customer for a payment that they make. And on the other side, there'll be a stub where you keep your records. For you, that stub part is very important because that will keep a track of all the income that you have got, right? Now, issuing a receipt is required by law. It is a right of a customer or a client to request a receipt. So this is something you have to keep in mind and make sure that you have the facility or the provision to provide a receipt in case one of your customers asks for a receipt. Now, depending on what kind of business that you do, sometimes people might ask, sometimes people might not ask. For example, if your startup is in software development and you sell a software product to a company, most definitely they will ask for a receipt for their record purposes, and it's a fairly big ticket item. Let's say you start a startup selling lunch packets. People who buy lunch packets are not going to ask you for most probably not going to ask you for a receipt. But still, in case somebody does, you can't say you can't give. So better be ready with that. In a receipt, there are 5 things which are important or must-haves. I have put them here. The date, the amount, receipt number. Now, this is something that you might forget, but this is very, very important, because to reconcile your accounts at a later date, when you're doing your accounts, this receipt number is a very important thing. So have a unique number for each receipt. So you know receipt number 1, 2, 3 that was issued from your company, right? It can have letters also, some serial number, that's fine, but have a unique number. Description, what this receipt is for, and the purchaser's name or identity of that company or person. 6, I have put here as an option, but it's good to have. It's not a must, but it's good to have that you in the receipt itself, in the receipt stub, not in the receipt, but in the receipt stub, you note down whether you received cash or if you have received the amount by check, the check number. Depending on what the transaction or this thing, sometimes it could be even a online transfer, then you can note it down that this was an online transfer, because later when you're tracking it, this will help you. At any point, please feel free to unmute yourself and ask a question if something is not clear, right? Second thing is the payment voucher. This is for all the payments that you make from the company. Again, just for the simplicity of explaining, I have taken a format of a printed payment voucher. You can use a soft version, no problem. Payment voucher is what you will fill whenever you have to make a payment. Let's say you have to buy some tools. So you went and, depending on whatever your business is, let's say you went and bought a drill or a hammer or something like that for your business. Then payment that you have made for that, you put in the payment voucher. Now this will also have a PV number, a payment voucher number, just like the receipt number. The payment vouchers also should have, each one should have a unique number, because later that's going to help you to track it. The date, amount, purpose this money was spent on, and the payee, to whom did you pay this money. Again, here also on the side I have put optional items. Mark whether it was paid with cash or whether it was paid with a check. If so, put the check number, because this will later help you to track these. And also number 7, I have put prepared by and approved by. This is also good to have. Sometimes initially when you start a startup, maybe there's only a couple of 1 or 2 people. So it might not be a big issue for you to track down who prepared the voucher or who paid the voucher. But when the company grows a little bit bigger, there has to be a code of authorizing. Certain people are authorized to prepare the voucher, but you need the approval of another person. Even when you have, let's say, 3 or 4 partners, maybe you can put in your articles of association or in the company this thing that at least 2 partners need to agree on a payment. You can even put payment amounts. Let's say for any payment over 50,000 rupees, 2 people have to sign. So then on the voucher, prepared by 1 person, approved by 1 person, or you can even have 2 signatures approved by those 2 people. Because sometimes it can happen, maybe you have, let's say, 3 or 4 partners. 1 person might go and spend the money of the company without others knowing or without their approval. So it's good to have that kind of checks and balances in your company from the beginning. So if you say, okay, 2 partners or 2 directors have to sign on a payment voucher, then have it. That you have the freedom to set it up the way you want. Third one is a record book. Now I don't want to use very technical terms here, so that's why I'm going to just simply call it a record book. I can even call it a financial diary. Now some of you must be used to writing some diary where you write what happened during the day. Same thing, but here you write only financial things. This you can write in your own language in just simple English. You don't have to there's no technicalities or anything. The whole idea is that you record every financial transaction that happened during the day. For a startup, is very easy because, as I said earlier, you won't have many transactions. In a given day, maybe you might have 5 transactions, 10 transactions, that's fine. Just write it. You got this much amount from this person for this purpose. Just like writing a diary, just write a description. So when you have this, and for each day you have written this, at the end of the year, when you have to do your accounts, when it's time to reconcile these accounts, it's very easy because there's a description of what happened. This is probably one of the most important thing, but also one of the most easiest things to overlook. Because even sometimes when you do have your receipts and your vouchers, it is not always easy. There can be similar ones and there can be confusion. But when you have this, and because this is it's descriptive, it describes what you have received that money for, or from whom you have received it for what purpose, or to whom you have given that money for what purpose. It is very, very easy for you to keep a track of this. Now, if you have these 3 documents, now all these 3 are very easy. The receipt is very straightforward. The payment voucher is very straightforward. Record book is very straightforward. Very easy. You don't need to know any bookkeeping or accounting. If you can maintain these 3 records, it is enough to run your company for the first year or 2, right? It will depend on how complicated your business, or not complicated, but how complex your business is. But for more than 90% for most business startups, at the initial stages, this will be sufficient. Now, what you can do once you record all this transaction is take this to a person who knows, who has some background in finance and accounting. Today, there are a lot of small accounting companies, not the big names because they will be very expensive, but there are so many qualified accountants with their own practice, like small companies, or even for our companies and some of the companies that I have been involved in with startups, we also do the same thing. We go to them, give them these 3 records that I just mentioned that you have prepared. Then they will be able to prepare the annual accounts based on these 3 records plus your bank statements. Because when you start your bank account, there will be bank statements of your transactions. From that, they will construct your entire accounts for the year. Once you prepare those accounts, then you can get it audited through an auditor. Then you can use it for your tax if you're here to file a nil report. All of these things can be outsourced, and it won't cost you that much also. Because to now say, if you don't have the accounting knowledge, if you are going to hire an accountant or somebody to work for this startup, it's going to be costly. It's not practical. I mean, as a startup, you can't afford that. You can't do that. But doing this method where you record it in those 3 documents and taking it to a small accounting company is very much financially feasible. It won't cost you much. Depending on where you and who you take to, I mean, the amounts will vary, but maybe for 15,000, 20,000, 25,000, something like that, you can get your annual accounts done, and then it will be done by professionals, so they do it the right way. So this is the best practical tip that I can give most of you who are here, who are not from accounting background. This is how you can get around that requirement. There's also accounting software. There are also, now I showed you how it's done on the manual way, but there are Excel sheets and there are even downloadable formats for these Excel sheets. So you can do all of this in Excel also. So I encourage, if you can do it in Excel, to do it in Excel because it's so much easier, right? And also there's accounting programs like QuickBooks, Xero, Wave. So if you either know how to operate those, actually they are not that difficult to learn also, but that I will leave it up to you, right? Maybe you might not be able to acquire these software at the very beginning of a startup. So that is up to you, but those options are also there. That's what I want to let you know. At this point, are there any questions or anything that you want to get clarified? Anybody? Okay. Let me move on to now the next two slides. This slide and the next one, I'm just giving it to you for just familiarization purposes only. You don't have to know what this is or how to do. Basically, you don't have to know how to do this. But since it will come up in accounting, bookkeeping, I just wanted to familiarize you with this. That's all, right? But you can basically ignore this slide and the next slide. Basically, now when you're doing accounting, there's accrual basis and cash basis. Sometimes there's also another version called tax basis of how you do your accounts. Now, normally, a person who's just writing down accounting, your transaction details. Now, let's say on the 1st of January, you have to pay license for a software license for 1 year, right? You have to pay it on for the whole year, 1st of January. Under cash basis, because you spend the cash on 1st of January, you will put 12,000 on 1st of January. Under accrual basis, basically what that means is, now I'll tell you why this is important, because when you're properly doing accounts according to the correct technical way, you have to do it on accrual basis. You can't do it on cash basis, right? So that is why I'm familiarizing you with this idea, but you don't have to sort of, it's not possible in a session like this to sort of give you the necessary knowledge on how to do it, but just familiarize yourself with that word and the idea that there is something like this. So according to accrual basis, that software cost is recorded as it's consumed. Meaning, now let's say for 31st January, you will put 1,000. For 28th February, because if you are doing monthly accounts for each month, although you pay it on the 1st of January, you consume it as you go throughout the year. So the cost is also spread out like that throughout the year. Now you might wonder, so what's the big deal? I mean, why is it different? Or, so why do you spread it out and why do you have that system and this system? But let me give you a small example why this might be become an issue or why this might be important. Now say you have a furniture business, right? You make wooden furniture. Now you go and to buy wood to make furniture on 2001, December 26, you go and pay a person who sells wood, bulk wood, and you buy your wood. However, although you pay him in full for the quantity of wood that you have ordered, he won't deliver it to you till January 5th on 2002. But you have already paid all the money on December, right? On January only, you will accept that load. Maybe he has to still cut it or size it or whatever the issue might be, right, on this date. Then you will be producing these goods after 5th of January. You will be producing these goods in the next months to come. And on 10th of December 2002, a furniture shop buys these goods from you. You deliver it to the furniture shop. They accept the goods. And you also present them with the invoice, but they don't pay you right on that day. They say, okay, we will process the invoice and we'll get back to you with the payment. And they actually come to you with either cash or the check or whatever on 10th of January 2003. Now, if you go on cash basis, when you do, let's say we are going on, our accounting year is from January to December. Just for this example, we'll assume that is the case, right? If you take 2001 accounts, there is a cost of goods for wood for this year. So whatever that cost has gone into 2001. Actual production of the goods and actual the business end of things have actually happened in 2002. But what you have received, your money will reflect if you're going on cash basis in 2003. So 2003 accounts will have like a bonus amount of cash, in the sense it will have an inflow for not with no corresponding cost, right? So now you see where the problem might happen. But now if you do this according to accrual basis, although you have paid in full, this will be a paid advance. That payment is recorded as when these goods are delivered in 2002, right? So it will go into 2002 accounts. Also, when these goods are sold to the furniture shop, the sale also is booked in 2002. Although you actually receive the money later, it will be recorded as a receivable, but that will come into 2002 accounts. So this entire transaction will reflect in 2002 accounts. So don't you think it's a more fair way of projecting your business? Because most of the business and things have happened during this year, right? So if you didn't much understand that, that's okay. But I just sort of showed you there are things like this also in accounting, right? Then there's single entry versus double entry. Again, you don't need to know how to do this at this stage. I mean, if you don't have financial background, that's fine, right? But just to mention, there is something like this as well. Single entry is the normal accepted accounting practice is a double entry system, right? But if a layperson who doesn't have any background records a transaction, most often they will do it as a single entry system. Let's say you spend 100,000 rupees on a laptop for your business, right? Normally, if you without a accounting background, they will just write it down as expense for a laptop, 1,000 rupees. In the double entry system, every entry is entered in two places, right? So you will spend cash or you will deduct cash, 100,000 as an expense. On your asset side, you will have a plus 1,000, that is the asset that you're receiving when you make that payment. So the same transaction is recorded in two places, right? Again, this one also you don't have to sort of, if you don't understand it, that's fine. I mean, it's just I put it out there so that you know that these things are also there, right? Okay, now this is a little bit more, this is something that's more important and to you. Any question, or please mute your mic. Okay, now this is something more relevant to you in your business, right? This is basically understanding about gross profit and net profit. If you're having sales of, let's say, 100 rupees, then cost of goods, the raw materials that go into making that, right? Now, say if you're selling cakes, cake business, your sugar, your flour, your butter, all of this will fall into this 60 rupee cost. This is called the variable cost, because more cakes you produce, that number will increase. Less cakes you produce, that number will decrease. So then you come to something called gross profit. That is sales minus this variable cost. This concept is very important because if you are making losses or if you're not making enough margin at this gross profit level, you are having a problem with your business model. For a startup, there might be very few exceptions where for various reasons, now say if you want to first prove a certain working model or something, again, if I go to that cake example, I'll go real fast, right? Normally, a business wouldn't go and buy their ingredients from a supermarket. They will buy it from a bulk wholesaler. But when you first start, just to see whether these people like your product, just as a proof of concept, maybe you will make 5 cakes, 10 cakes like that initially, just to see how it goes. So as a proof of concept. During this time, you will purchase it from the supermarket. So your cost will be high. And here you might have a very low margin or sometimes maybe even a loss or a low margin. This might be like a very exceptional case, exception situation, right? But normally when you do start your operations in normal operation, this can never be your gross margin. It has to be, you have to have a good margin here. If this is either low if it's negative or low, even if it's low, you are having a problem with your business model, you have to rethink, because the more, if it's, let's say if it's minus or something, the more items you make, you're in bigger financial difficulty, or you're losing money. Then there is something called fixed cost. Fixed cost is like your rent. Now, whether you make 10 cakes or 100 cakes, the building that you have rented to, have your bakery or whatever, that rent cost is fixed. Equipment, you have bought some cake mixing bowls or whatever, whatever you use to make that, those are also fixed to some extent. If you expand the business to a very large size, maybe you want to buy more items, but generally, whether you have 10 cakes a week or 20 cakes a week, these things will also tend to be fixed. So once you deduct the fixed overhead also, then you come at the net profit. So sometimes when you start a startup, this line, the net profit line, can be a negative in the initial stages, because you have already you're incurring a rent cost and various other fixed costs are there until you reach a certain size. Let's say you come to a point where you are baking 100 cakes a week or 50, it might depend from business to business, but the scale, but until you come to a certain scale, you might have a negative figure here. Actually, most startups do have negative net profit for the first few years. Don't be afraid of that. That is normal, right? However, at the gross profit level, that is not the case. As a rule of thumb, this has to always be positive. As I say, there can be few exceptions, but as a rule of thumb, if this is negative, then you're having a problem, because that means more items you make, the more money you're losing. So this is a concept that you have to sort of maybe we can share these with you later, but really think about, right? Then there is also the same thing here, a difference between your capital cost and your working capital. Capital cost is when you start a business, you will have to invest in machinery, maybe you might have to rent a place to do your business like that. So this is your capital cost. So you must have an understanding of that versus working capital. Because sometimes when people start a business, they just take money from just one pool and put it and say, this is the business cost. So capital goods also are in that same pool. Working capital goods like the raw material are also in the same pool, and you will not have a good clear picture of which is which. Now, working capital is something that will go up with the scale of your business. The more cakes you make, if it's a cake business, your flour, your sugar, your butter, all of those consumables, even including electricity to some extent, all of these things will go up, right? So that distinction, you must have this idea in your mind, even if you don't have a background in finance, you must have this idea in the back of your mind. There's this capital goods, and then there's working capital. And this working capital is the thing that increases when you increase the scale. And the working capital is the one that you have to actually really, both you have to manage, but this is the tricky one to manage on an ongoing basis, right? Okay. Here we come to another. Now this part, earlier I gave you like the technical things that you might need to, technical in the sense how to get about doing your keeping part. But here, this is probably the most important part for you as a startup about the finance, the philosophy of finance going here onwards, right? Now let's look at success rate of startups, right? Who thinks, or in your this thing, maybe of all startups that people start, more than 50% succeed? Can I have a show of thumbs up? Can the host please give me a rough, because I can't see now the thumbs up. Can you give me like a rough idea what kind of a percentage has put their thumbs up?
Not much actually.
Okay, good. how many of you think about 25% of all startups that people start end up being successors and becoming successful business? Oh, so 25%. How many? Thumbs up, please. Can the host please tell me roughly like what number is that percentage? Again, is it like a minority?
Yeah, actually.
Okay. Good. The success rate of startups are a very small percentage, maybe 10% or less, meaning 90% of all startups fail, right? So now let's take a moment and actually ponder and think and let it sink in. What does this mean? Now, if we are having today, let's say 50 participants, and if all of you go and start separate startups, if all of you are interested in doing that and you do that actually, maybe out of this 50, 5 will succeed. After about 3 or 4 years, if we look, only 5 companies will be existing. Most startups, maybe the wrong word, vast majority, about 90% will fail. This is a fact. It's a statistic. You can check, you can Google this up after this session, right? Internationally, not just locally, in any country, that is a cold, hard truth, right? So the success rate or numbers are not looking very good. At least in the first iteration or the first attempt, you might fail. Maybe you might come back with a different business, another business, and after a few attempts, you might succeed. But the failure rate is very, very high. Then let's for a moment think, why do startups fail? Why is there such a high percentage of startups failing? Now, according to my experience, right, there are many factors, various factors. Actually, let's have an interactive session. You can unmute your mic, and can I have some ideas? Why do startups fail? So many. What is the reason? Let's have some ideas. Just
not sufficient funds or portfolios or good ideas to take the business forward.
Yes, good. Not sufficient funds. Yes. Well, what else? Anyone else or any other ideas? Just feel free. I'm not looking for right answer, wrong answer. Just feel free to give your whatever your ideas or what you think. Let's quickly do this because we have to move on. Any more ideas? Anyone else?
Maybe the idea you have isn't sustainable enough.
Okay, good. Anyone else?
Unable to compete in the market.
Okay, good, very good. Let me now give you. Now, this is according to international research. There are so many researchers out there. I mean, you can go to Google and find so many ones. So this is one that I have found. So this has done a survey in 193 failed startups, and then they are looking at what are the reasons why it failed. So I'll give you a moment to just look at this. But let me point out something here. Now, first one, business model not viable. Right? That is the highest. I think 26% is due to that. There is a large, when you say the business model, there's a large finance part in the business model. When you're planning your business model, structuring there's a large financial part here. Right? Number 2, again 24%, ran out of cash. Someone very correctly pointed out, I think the first person who answered pointed out insufficient funds. Yes, you're absolutely right. that is almost as high as this, about 24%, right? Now, those two combined itself is 50%, right? Of course, there are multiple reasons, so this might add up to more than 100 because sometimes there are two reasons or more reasons for a business to fail. And again, lacked financing / investor interest, 13%. So what I want to point out here is the main contributing factor, financial factors that are the reason for these companies to fail. This has been, apart from all these researchers, I have been involved with several startups here in Sri Lanka, also in various capacities as a financial advisor and as a director, partner, and various. And I can tell you from my personal experience also, reason why most of them fail is due to not having the right finance knowledge, right? This is something I want you to very seriously think and take it in, absorb, because it's a fact that most of these startups, very high percentage, right, like 90% will fail, right? And this is the number one reason why it fails, right? Now, those percentages might be statistics, right? I can say it's 90%, this percent, that percent, right? Everybody who starts a startup putting their effort and money and all that, don't do that with the intention of failing. Don't do that if they are not sure. Don't do that just for the fun of it. All of them think they have the winning solution, they have the winning business model. All of them think they have a winning product. They have everything, They're so confident. That's why they put all their time, money, energy into this. But in spite of all that, and a lot of enthusiasm, a lot of effort, everything, a very large percentage doesn't make it. Now, that's just a statistic, right? Now, why is it important to you? Because now I told you why it fails, or the main reason why it fails. So this is like, if there's going to be bad weather, maybe you can't help it. But if somebody gave you a weather warning earlier, at least you can take an umbrella, right? So now at least I have given you a heads up. If you start a startup and if a lot of them fail, here is the reason I'm telling you right now, right? In my experience, with the startups that I had a role to play or experience, also it has been due to this, not due to, a lot of the times people will think the product has failed or the market has failed. There has not been enough interest in the market and a lot of things like that. Those also are there, but in most cases that was not the case. It is the finances, right? Right. Now, when I talk about these finances, I want to tell you about an important concept, what I call the finance knowledge body. Let me explain this by giving you an example, right? A historical example. Long time ago, thousands of years ago, people built amazing tanks, irrigational tanks, in Anuradhapura Polonnaru, right? Irrigational tanks. Back then, they did not, probably they wouldn't have had structural engineers, irrigation engineers, all these engineers would have not been there. They may not have had universities, but somehow they built it. Yes? So then one can say you don't need engineers and all these architects, engineers, universities, or whatever those things to build these great monuments, or great works of engineering. But those people had a body of knowledge, right? Which we don't have. Why is this important? Because quite commonly when I argument or when I go about this, that comes is they say, look at this particular businessman, this particular Mudalali who is a billionaire, who may not have completed school. You may not have had financial knowledge, or who is not an accountant, who has not studied finance, all that is there, but now he has built a business which is millions or billions or something. So then you don't need to have finance knowledge to build a billion rupee business, multi-millionaire billionaires. That is the argument, but that is wrong. yes, that person may not have had a formal education or qualifications. Maybe when they started their business for the first 5 years, or it could be anything for the first 5 years, 10 years, whatever, they may not have even employed an accountant, maybe for the first 5 years. Then people will ask, okay, so you don't need to have finance knowledge to do business. No. Same thing like saying this, those days they didn't have these engineers, but they, how they built this. Today, if I ask, now you and I also are not, or most of you here may not be irrigation engineers or architects. Can you build a tank like that? No. Can I build? Absolutely not. Because I don't have that knowledge body. I can't compare myself with the builders of that and say they also did not have whatever educational qualifications or those things. I also don't have, therefore I can do what they did. You will be absolutely wrong. This is a very fine point that I'm trying to, a very subtle point I'm trying to make. I hope you got this, right? You don't have to be, what I'm telling you is you don't have to be accountants. You don't have to necessarily employ an accountant in your company. In any ways, in initial stages, you will not be able to do that because, you won't have financial resources to do that, money to sort of employ an accountant in your startup. That is understood, yes. But you must have a sense of finance, right? This is like the underlying, it's like the blood that runs in a person's body, Everything, the business runs on this finance, and you have to have a understanding. You need not know how to do accounting, that is not needed, but your philosophy, underlying philosophy has to be there. Just to prove my point or what I'm trying to say, let me also give you another example. These are three people that I'm going to take as examples, 3 examples from my real life I'm going to show you, right, about the financial sense. Now, my wife is a doctor and she has many colleagues and friends who are doctors, right? And some of these friends or these colleagues who are doctors are very clever. They are, anyways, in the Sri Lankan system, to become a doctor, to study, you have to be very smart, very clever to be a doctor. Some of them have postgraduate, and some of them are like senior registrars, some are like consultants, some are senior registrars, a lot of qualifications. And some of them have very big practices, medical practices are, very intelligent. But there's a whole lot of these doctors who have absolutely messed up their personal finance, right? It's in such a mess that, you wonder how is it even possible, because they may be very smart, they may know the medical side, but their finance knowledge is so poor. Now, by saying finance knowledge, I don't expect any of them to be accountants or having a technical background that in finance. No, but general common sense in finance, having an idea. Because I have helped personally because they are my wife friends, through that some of them have approached me, and I have helped quite a number of them to sort out their personal finances. Unimaginable. Some people have bought cars from their credit card. Can you imagine that? May not be not the whole payment, but at least partly financed their car purchase from credit cards. Some of people have even bought property from credit cards, or partly they have very, some of them have high credit limits. So use part credit card also to, you never finance a long-term asset with a short-term tool like a credit card. And you know what the rates are in credit cards. So it's just absolutely crazy, right? Example number 2. There's a fruit seller down our road who started his business fairly small with a small karatte and some fruits on that. Now it has grown to quite a size. So he has now a demo batta type of a thing and quite a good thriving fruit business. So when I go there to buy fruits, I just observe what he's doing, how he's doing his pricing. Because let's say when he buys from the wholesaler 100 kilograms of bananas, he knows he's not going to sell 100 kilos of bananas. Some of them will be spoiled, some of them will go to waste. But when he does his pricing, he calculates for all of those things, and then he does his pricing. This fruit seller, again, does not have technical knowledge, any kind of technical knowledge in accounting or finance, but his financial sense is superb for his business. Compared to some other, even let's say professionals or some other people, he knows exactly in financial terms what he's doing. He may not know the theories behind it, he may not know technical things behind it, but when I speak to him, sometimes I am amazed. How does he know so much about time value of money, all of these things? Stock, stock management is an important part of finance, how you do stock management, all of these things. It is this kind of sense that I am sort of saying that you have to acquire from someplace, right? Then next example is a carpenter or a person who makes wooden furniture. Recently, I had a conversation with a person who was making wooden furniture. He's not even a young person, so he's belongs to a totally different generation, maybe 60 plus years old, right? Again, he does not have much formal education, maybe school education, that also may not have completed. All his life he has been a carpenter making furniture, right? The amount of financial knowledge, the financial understanding he had about his business amazes me. When I had that conversation, I just had that conversation soon after, because before I went, some people from a furniture shop has come there to buy some products, right? There was apparently what he said, there was quite a big margin also, right? But he just turned them away and said, no, sorry, can't, don't have the products, or can't, I have some other work and can't deliver. Turned away these customers, and then after that, we had this conversation. I'll give you an example. Let's say he buys wood or whatever consumables to build a furniture set or a chair or whatever at 5,000 rupees, right? Then the cost of his, let's say, because he has to use power tools, electricity, all of those other things also, apart from the consumables, let's say other things, another 1,000, that goes to 6,000, right? And a furniture shop comes and asks him for this particular piece of furniture for 8,000. So now you're looking at a 33% markup, right? 6,000 is his cost of goods, 8,000 is the amount they're offering to buy this set, right? If that happens to most of, let's say if it happens to you, how many of you, again, can I have a thumbs up? If let's say this was your business, somebody came and asked you, okay, cost of goods 6,000, they are going to pay you 8,000. How many of you will sort of sell the product to them and think this is a great business? 33% markup. Can I have a show of thumbs? Can the host please let me know whether there are any thumbs up? Yes, no?
No, actually.
Okay. Because here the reason was this. It was an issue about timing, right? Now, when the furniture shop buys it at this price, the margin is great. Now, but they don't give the money at the gate when they take it. Instead, what they do is when they sell it only, they settle this guy, right? So although the margin is good, and if you do a simple calculation and think your margin is more than 33%, just over 33%, timing, there's an issue because he's stuck. He is going to get stuck with his working capital because he has already spent that 5,000 on the wood. He has already spent another 1,000 on other things. He's going to get paid maybe 6 months down the line because they'll take it to their furniture shop and keep it there. When somebody buys it only, this guy gets the payment. This is why, although it seemed like a good business on the surface, he turned away that guy and sent him. So this guy also has a very good, that's why he has a thriving business, has a very good sense of finance. It is this kind of sense that you need to develop if you are going to succeed with your business. So this is what I want to sort of highlight to you, right? Okay, before that, now let's say if you take now in a business, there are core business activities. If you are manufacturing something, your manufacturing operation is a core business activity. Your sales and marketing is a core business activity. If your sales guys don't do a good job, or if they do half a job, when you can do 100 million a month, 200 million a month, you might do 100 million a month, because there's a direct relationship in their performance. It's a core function. Manufacturing, same thing. It's a core function if you're into the manufacturing business in this. Then there's something called support services in a business. If I take, for example, the legal department in a company is a support service. It's a very important service. I'm not saying it's not important. It's very important because they protect you from lawsuits or in contracts, in negotiations. They protect the company. They're very important. But for the performance of the month, whether you're going to sell 100 units or 200 units, does the legal department directly have a bearing on that? No. So that's why they are called a support service. Lot of the times, this is a practical problem that even I had when I worked with a lot of startups that I have worked with. They think finance is also a support function. Like they think the people who manufacture or people who whatever make the product, sell the product, that's the core function. Finance is a secondary function. Once they build something, once they sell something, it's the job of the accounting function or the finance function, like a bean counter to count, okay, this month you sold this much, then you calculate what was your cost and say this month it's, cost was this. Maybe do a budget or projection based on that, next month or next year you increase it by 10%. So basically a backward looking thing like that, a support function, but that is not so. It is a core business activity that runs through all through all the functions of the business. In all the decision making, this finance has to be a consideration in all the business decision making. Otherwise, your business will be in trouble. So this is a very fine point I want you to really, really think about and sort of get it into your system, right? So next two slides are basically, this is one of the most common areas where a lot of businesses fall into trouble. Like I explained in those examples earlier, understanding your cash flow. A lot of businesses go bankrupt or new startups go bankrupt, not because their profits are low, but because they have a problem with their cash flow. Cash flow means you need to have liquidity or cash to buy to finance your working capital. Now, if all your cash is tied up somewhere, like the early example I said, you have built something, sold it to somebody, but you don't get the money immediately, how are you going to buy your next stock of raw materials to produce your next set of goods? You're stuck. So this is understanding the cash flow. Lot of the time, especially startups are susceptible because other companies, these are practical things, right? Established companies will sort of put pressure on them to give things on credit. And when you're a startup and when you're just starting, it will be very, very difficult for you to make some sales and break into that industry. Sometimes you are forced to give a lot of credit. Maybe the buyer will say, I'm only going to pay you after 3 months. So when you're making those decisions, you have to know the financial implication of that, what you're actually doing. Because without that, the business will be in trouble. Sometimes you might have to say, even though it looks like a promising business, sorry, we can't service your requirement. Now, that decision from industry to industry, how much of credit you're giving, how much of discount you're giving, from industry to industry, business to business, this will vary. And you have to, according to that, take decisions. But all I'm saying is when you do take that decision, quite often that decision comes under pressure, right? Nobody wants to give a discount. I mean, obviously you want to get the best price. Nobody wants to delay a payment that is due to you, right? You want to get it as soon as possible. But sometimes the person in charge of sales, the partner, your business partner who's handling sales will say, there's no way I can sell this good because everyone else is giving this credit. Everyone else is selling at this price. If you have to do it, you have to give a discount or you have to give them credit period, all that. It is up to you to make that decision, because as I said, if it's going to depend from business to business, but this is what I'm telling you. When you make that decision, you must have the financial knowledge to know the full implications of the decision that you just made. Because sometimes giving that credit period or that discount, not all the time this happens with credit period, because getting money in Sri Lanka from customers is very difficult. Anybody who has practically run a business will know this. Sometimes it might be better for you not to do that business. That is a decision that you have to make, and you have to make that decision based on financial knowledge, right? So this is, then you will have to do, when you first start, budgeting for your financial requirement. This is also very important. You have to have an estimate of your burn rate. One of the most one of the common reasons why some of the startups don't make it is because they don't make the correct calculation for the, what you mean by burn rate is at the initial stage, how much of cash you are going to consume, right? And when you make that calculation, it's not easy to just do it in a piece of paper and just say, okay, every month it's this, and and do a very simple calculation. Let's say you're giving credit, or you have planned to give credit for 30 months. Maybe you'll have to do like a stress test and see what, for whatever reason, if the customers don't pay me in 1 month, what if they pay me in 2 months? What if they pay me in 3 months? You'll have to do a stress test like that and see the viability of your business. Because if you just do all the calculations on paper thinking people are going to pay you on time and sort of balance it, you're definitely going to fall into trouble, because whatever you plan on paper is never ever going to happen that way. Just see like the COVID, before it happened, nobody knew it's going to happen, but it happened. Now that will wipe some businesses out if they don't have the resilience to survive through that. So when you do your calculations, planning, you have to account for that. Not because of COVID, you don't know what else will hit in the future. It could be the business environment, it could be anything else. So it is very important when you do this budgeting for your requirement, initial requirement I'm talking about, right? To start a business, you might think with 200,000, I can do that. But most often, if you really think about it, it might take you 400,000. And if you do start it with 200,000, what's going to happen is in the middle, you're going to run dry and your whole business will collapse. When you run dry, what happens is then you're forced to make shortcuts. This is what we have seen, meaning shortcuts, meaning without, you'll compromise on the service quality, you'll compromise on the ingredients or whatever, the raw materials that go in there. And as a result, you'll have a substandard product and the whole cycle will buckle down on you, right? So having that sense of that financial sense and the common sense is very, very, very important. So I close my presentation with that, and now I open the floor for discussions, and my other two colleagues are also there, so you may unmute and ask any questions or anything that you want to discuss. And I welcome, please invite Prashana and Saman also too. You can answer these questions because they also have a vast experience and knowledge in this subject. Okay, over to you.
Yes, Mr. Kavinda, before moving on to the question and answer session, I would like to give a small shout out to one of our sponsors as well. So meanwhile, this announcement goes for the participants. If you have any questions, you may, after this set of advertisements, you can unmute yourself and ask from Mr. Kavinda directly, or you can send them in the chat box. And people who are joining with us through the live stream on Facebook, they can put their questions in the chat box there and they will be directed to us. And now I would like to give a shout out to our bronze partner Seema, IT solutions partner My Shopbox, and advisory partner PwC.
Our story is one of reimagining. Reimagining who you can be, what you can achieve, and how SEMA can support you. Founded in the UK in 1919 with the belief that an accountant's impact goes beyond the balance sheet, SEMA joined forces with the AICPA in the US to form the Association of International Certified Professional Accountants. Today, we serve members and students in 179 countries and territories. Contact SEMA Sri Lanka.
Meet Nadisha and Nipani. They make upcycle products and want to share this passion. So they started a business and took it online using Shopbox. Shopbox is an online commerce solution which allows anyone to easily and affordably sell online. It provides all the tools needed to set up and run your own website. Have your online store set up in minutes by entering your store details and uploading your product. Taking the hassle out of setting up and maintaining an online store, Shopbox helps you work on the more important things, like growing your business. Make your business successful. Shopbox.
Are there any questions that you would like to ask from Mr. Kavinda? Either you can unmute yourself and speak up and ask from Mr. Kavinda directly, or you can direct your question through the chat box of the Zoom chat. Thank you.
Any questions, anyone? In the meantime, let me ask either Prashana or someone, do you want to add anything to what I have already said? Would you like to maybe share some experience that you have had or add anything to this?
Kavinda, I think what you shared was a very hands-on experience. So it's not a theoretical thing, and that's something, really as startups use. So there's nothing to add. That's very practical what you mentioned.
Okay. Someone, you want to add something? Okay, let me again recap or sum up my the final take-home message. That is, you have to acquire the finance body of knowledge into your startup. I use the word acquire because either, let's say at the start, the promoters or starters, either you must have, or you can get someone who knows to partner with you, or you can get it from outside. It doesn't matter how it comes, but that financial sense have to be there. This is not necessarily the technical knowledge on how to do a set of accounts, right? That you can even outsource and get it from somewhere. But in your day-to-day business decisions, a financial sense has to be there. Also, if you're getting from outside, let's say a consultant, somebody, it could be, when I say consultant, it could be even family or friend or somebody who knows something about finance. It can be that, because as a startup, most probably that's the source that you will get. When you do get, it is very important that you get them in the decision-making process, and that you give due consideration to what they sort of say, because again, in my practical experience, something I've seen is sometimes in the decision-making, sometimes the finance aspect or the person who's advising on finance is not always included in that decision-making loops. Some of the things have been done without considering a financial aspect, and sometimes then it's too late. So in that decision-making thing, you have to acquire that financial knowledge body, either through external source or through internal source. Either ways, it has to be there. Without this, I have not seen, I don't think there has been any successful startup or company. It has always been there behind any successful business. It is a must. There's no way around it. Only thing is, as I said, it may not come in formal sources, so it might not, come from a person who's a qualified finance person or something, but even a person who may not have even completed school sometimes will have the necessary sense, right? That financial sense to do a very successful business, just like how I sort of showed you with those examples of the carpenter and the fruit seller, right? But not having that, even if you have a lot of other technical knowledge, because a lot of startups I have worked with, they have had a lot of technical, people who start a business normally know their subject, that's why they start that business. So usually they know their subject matter. So there won't be a problem there. But if they think only by knowing the subject matter and only by being able to sell the product, they can make a successful business, they will be sadly mistaken, because if the right financial decisions are not made and those financial principles are not followed, in spite of having customers who wants to buy your product, just like in the carpenter, there are people coming to his door to buy the product. So you'll have enough people buying your product. Maybe you make a good product, right? That's why people come to buy it. But in spite of all of that, your business will come crashing down if you don't have the financial sense. That financial body of knowledge has to be in your decision-making process. How you get it is then up to you. Whether you have it internally, externally, from where you get it. There's nothing to say you have to get it externally or from experts or anything like that. You can develop it maybe yourself if you have that, develop it, but it has to be there. So those are my parting thoughts for you to sort of think about.
Yes, Mr. Kavinda, we do have two questions directed to us.
Okay.
The first question is through a viewer from Facebook. Does ratio analysis do a huge impact on taking decisions regarding startups?
Okay. Shall we invite Prasanna to? It's like this. yes, you can do ratio analysis and all of these things, but it's the idea behind it, or the thinking, financial thinking behind it, that is important. So as long as you have that financial sense and basically you know where things are going, you should be on the right track. Yes, you can do ratio analysis and it will be very useful for a company, but it will be more useful as you go along. It will be more useful for a more advanced, in your initial stages. If you have a normal financial in the sense common sense, you should be able to navigate through your daily requirements. Anything else, Prashana or someone you want to add to that?
There's one more question. Is it easy to open a current account on a company name in Sri Lanka? If so, how is it done?
Very easy. You just have to go to the bank with the documents of your company. So they will give you a list of documents like your registration, company registration, and basically those are documents that you already have, right? If you have registered a company in ROC, you will already have those documents with you. So they will just need copies of that and the information of the directors. Only thing is to open a current account, they will require you to have either deposit like a minimum balance in the account of, let's say, about 50,000. This varies from bank to bank, this requirement, the amount. Usually all the banks do have a requirement, but how much that amount is, whether it's 25,000, 50,000 or more, will depend on the bank. But it's very easy.
Okay, we have one more question directed to us. There are consultancy companies which do the startups, the finance and bookkeeping aspects. Is it better to hire such a consultancy if we are new to the business and if we have the financial capacity in doing so?
Yes, if you do have the financial capacity to do so, you can, like the bookkeeping functions, you can outsource. That is absolutely fine. But something that is kind of difficult to outsource, or at least you must have some sort of internal processes. Like earlier, what I said, when you're guiding the company in the direction where you want to go, and the financial sense and the input that is required for that, that you can get advice, but you will need a partner or somebody who's committed to your business. I don't know whether that part was very clear what I meant by that, because sometimes now, say doing bookkeeping or some particular thing that you want to get done, some service, yes, very easy. You can outsource it, and actually now there are companies, small companies that do it for very reasonable amounts. So it's not a very expensive thing if you go to a small company, or you can even go to somebody who's like, let's say, a part qualified accountant or somebody like that. It's very easy to do that part. But advising you on your financial strategy and going about the business, you can certainly get advice, yes. And if the people inside the company doesn't have that background, it's a good idea to get that advice. But whatever the advice you get, as far as strategy is concerned, you have to sort of on your own also validate it and sort of see. The reason I see, okay, let me give you another example. Let's say in the business you don't have anybody with financial exposure, so therefore you get a person who does as a partner, right, as a director in the company or as a partner in the company. Then it is different, because the fate of the company is also his personal fate in terms of his venture. So his time and effort and gain or whatever is tied to the company. So he will be more, that person, he or she will be more committed towards the company in directing it and take it in the right direction. Because otherwise, sometimes what happens, okay, let me give you this example. I have seen a lot of startups going to friends and family sometimes, let's say they say someone's uncle or somebody's some accountant or finance. So they may not be very closely, let's say, related or known person, but some known person. So somebody, because you're going there for a help and they want to sort of, maybe help you out, sort of this thing, they will very superficially look at your business and say, okay, Puta, so what's happening? Okay, very good, and then give you a set of advice, but without taking a lot of time to actually immerse in your business, understand what's your day-to-day problem exactly, sort of without that. And I have seen quite a bit of this also. So they will just look at it superficially and give superficial advice. So you have to be careful in that also. I'm not telling you not to take advice like that. If you have any, friends and family and all that, yes, please do take advice. But the value of the advice or good advice will come from somebody who's really committed to the company and also who will understand the workings and your daily problems and where your business is at and things like that. Another thing, just add to this, I want to say I have also seen this also happening a lot. Sometimes you take your business idea to somebody, either let's say a known person or somebody, you take it and show, because you want to get like a confirmation, a validation, and show, I have this idea, what do you think? They think it is their duty, sort of, it's partly a cultural thing here in Sri Lanka. In other countries, people are a little bit more direct, but here in Sri Lanka, people all, don't want to say anything negative or bad or, So they will look at a business idea and whether it's a good idea, bad idea, what they'll say, very good, Puta, very good, very good, you do this. That is, in my opinion, actually, that's very, I think it's something very bad, because that gives them false hope and false confidence, and that will send them down a wrong path. If there are issues with it, or if they see problems, they should genuinely say, I don't think this will work out. These problems are there. You should correct it. So when you get advice like that, be careful of that aspect also.
Okay, there's another question asking whether is it safe and won't it affect the income tax? I'm assuming he's referring to the previous question where is it okay to outsource financial and bookkeeping consultancy? But he's asking whether is it safe and won't it affect the income tax?
I'm not quite sure exactly what he's asking, but maybe what he's meaning is a lot of businesses have two sets of accounts, management accounts and audited accounts. Management accounts are the real accounts which they internally use for, which has the true picture that they use for internal purposes. Then they have another set called audited accounts, because for tax purposes, you need the accounts to get audited. But what they send for auditing is sometimes they might hide their profits or whatever, something like that. Usually it will be after some time that, now if you all are at the very basic stage of startup, this problem will happen only after a few years, because anyways the first few years you won't have, it's unlikely, I can't say you won't have, but it's unlikely most startups will have a profit to show for taxes. So most, first, it's the most common thing, first year, second year, even third year, you will file a nil report saying no profit, so therefore no taxes, right? You have to file it, but you don't have to pay. It's a nil report because you don't have profits. Question maybe what you're referring to is it safe to show your accounts to outside party because they can divulge the secrecy? Normally in practice, that is okay. It is safe. I'm not endorsing this, but it's a fact that in Sri Lanka, especially small businesses, a lot of them have two sets of accounts and they don't show all their profit. It is a fact, whether you like it or not. These are practical things that we see. Not that I'm endorsing that or saying that it's good. Actually, what I'm saying is for your own good, don't do that. Have the right set of accounts, because something that we see, we work a lot with the investors. These at a much later stage with private equity and investors coming in at a much later stage. at that stage, when there are two sets of accounts, there's normally an aversion on the part of the investor. And that can also lead to, because the investors will require audited accounts before they make the investment. So there can be a issue there also. But all of this, I don't think most of you have to worry right now, because this is I'm talking about maybe 5 years down the line after you start your company. So initially, it is safe to share your true accounts, the management accounts, and the audited different sets with the accountants, because they are quite used to this. They know this. I mean, this is a common practice that happens. Was that the question? Did I answer? I mean, or the person who asked that question, does that answer your question, or was it something else that you meant?
If there aren't any more questions, I think we can wind up this session for today. Yes, that was the question, and I got my answers.
Okay.
The person who directed the question has replied back to us saying that was the question he had, and that he got his answer.
Okay, good.
Okay, with that, I think we can wind up the session for today. So that brings us to the end of the second workshop of Jumpstart. I would like to thank Mr. Kavinda Dasanayake for joining with us today and for sharing your time and knowledge and your experiences with us. And I'm sure who participated today learned a lot of things. So once again, thank you very much, Mr. Kavinda, for joining with us, for making your time for us to share your knowledge.
You're most welcome, and thank you for having me.
Yes, thank you. And also, before winding up, I would also like to thank our valuable sponsors, without whom we wouldn't have been able to pull this off. So, Bronze Partner, Sima Sri Lanka, Knowledge Partner, Venture Frontier, Gift Partner, Shirtworks, Advisory Partner, PwC, Legal Consultation Partner, ELAW Chambers, Co-working Space Partner, Hub9 Co-working, Mentoring Partner, Startup X Foundry, IT Solutions Partner, My Shopbox, Media Partner, Chocolate, and Reforestation Partner, Turu. With that, we come to the end of the second workshop of the workshop series by Team Jumpstart 2020. So I hope you had a good session, you have gained a lot of knowledge, and I hope this will be really useful for you all in the future. If you have any idea of having a startup or in any kind of area that any kind of field that in finance that you would like to pursue. So thank to our participants through Zoom and Facebook. Thank you so much for joining us today in making this event a success. And I hope you have a good day. Good night.